The first section of life insurance taxes brought up some things you've already learned, as well as a few new items. Some of the more familiar issues are things like cash value grows tax-deferred within the policy, what occurs with the partial or total surrender of the policy, and how dividends might create a taxable event depending on how they're received by the policy owner. We've revisited policy loans and gave you some additional information about how a loan might turn into a total surrender if the amount of indebtedness exceeds the policy's cash value backing the loan. We then explored the potential effects on estates and how certain values might be included in the gross estate values, unless proper arrangements were made. The incidence of ownership rule was explained, as well as how to avoid these tax problems. This portion finished with how employees might see a taxable event if their employer pays more than $50,000 of group life insurance under the imputed income rules. We'll now discuss modified endowment contracts, MECs, and how a life insurance policy can morph into a MEC if certain IRS rules are violated. This will bring up the 7-pay test, which separates life insurance taxation from investment taxation, and the failure of which will reclassify a life insurance policy as a MEC.